S&P 500 index and interest rates, looking at the options. In a previous sabbatical, I examined the annualized returns from out-of-the-money call options. Annualized just means you divide by the number of days remaining with an eye toward getting the best returns. Here's a graphic of a simulation, and you'll see the farther out of the money the options are, we'll detail a little bit later, the better it is if you go farther out in time. Let's explain what options are. You can have an option to buy a stock, that's called a call, or you can have an option to sell a stock, it's called a put, and you can both buy and sell them respectively. If the stock price is above the exercise price of the option, it is in the money, has positive intrinsic value, and vice versa for a put. Otherwise, they're out of the money but still has some remaining value. There's a mathematical model for call options called the Black-Scholes, if you will, and it's a function of time, interest rates, volatility, as well as expectations. I looked at the options on the S&P 500, nominally called the SPX, and to get the options, I looked at the ETF, the exchange-traded fund called the SPY. This is an index that's purposely meant to represent the market as a whole. So what I decided to do for my sabbatical was look at the annualized returns for out-of-the-money puts and calls and compare the difference between the two. Turns out the data need a lot of cleaning up because other than the standard third Friday options, which tends to avoid problems with holidays, save the occasional Good Friday, you also have daily, monthly, quarterly, and long-term January leaps. And further, I took the average of the bid and ask prices when the market was closed because during the day, one or the other bid or ask, someone might be moving it to try to get a better execution. So with the data cleaned up a little bit, I took the extreme points, that is the nearest and the farthest, as well as the most in and the most out of the money. And here are the week-by-week results for 2024. You'll notice I was on vacation a couple of those days. Well, the first thing I compared it to was the interest rates during that same period. And look at that. They really line up side by side. But let's not stop there. Let's also compare it against the index itself. And likewise, let's see if there's any future prediction in that data. Well, as you can see by these scattergrams, nope, not at all. And of course, let's look at some statistics. Turns out there was a non-significant minor negative correlation. But you know what? This confirms something, the efficient market hypothesis, which goes all the way back to a random walk down Wall Street, and that is tomorrow's price changes are substantially random.